Good evening, ladies and gentlemen. This is Clueless Trading Frank. Tonight is September 20th, 2017, approximately 8:09 p.m. Eastern Standard Time. This free webinar session will be recorded and uploaded to the YouTube Clueless Trading channel that everyone should be subscribing to. You can always pass it around to your friends, and all the free videos that are posted up there, people have free access, as you all know. Full disclosure, this is purely for financial education and not for any solicitation or advice. And we shall begin. All right. Somebody's mic has a little bit of an echo, so please mute yourself. And you can always unmute yourself when you want to ask a question or whatever. Okay? Okay, somebody's, I'm getting a feedback from somebody's mic, so if you could kindly mute yourself. Not sure who it is. Okay, we can't be going on if that person doesn't mute themselves.
It's Mike's. It's Mike's mic. It's showing.
Mike, I think it's Mike.
Okay, Mike, can you mute yourself for a minute? Okay, I'm just going to mute everybody else. Mike, you there? All right, from my end, I'm just going to mute all and then unmute shortly. Okay, can everyone hear me?
Yes.
Okay, good. So it's just, I guess the mute function does work.
Yeah, I can hear you, Frank.
All right, cool. All right, so let's begin. So a couple of important comments that I always make, which are obviously very relevant to what's happening on the real trading floor, not, as I like to say, on the fake trading floor that a lot of other subscription services and people keep on touting around. First and foremost, this is an extremely volatile market. I don't need to tell you that. We feel it every day. And despite the fact that you keep on hearing everywhere else that the VIX is stuck here at 9, 10, and there's all complacency and there's no volatility, as you can, by now, you all should know that's a bunch of lies. There is enough volatility to deal with. We deal with it every single day. The volatility can be on a tight range basis. We're not getting 100-point swings. But we're certainly getting a lot of swings in a very tight range, and those swings are amplified and magnified when it comes to individual stocks. We know that very well. So even though the volatility, the VIX is stuck here at 9.78 and barely moves above 10 and keeps on getting slapped down, as you can see for all my charts that I've been putting out there, the fact is that that has no bearing on the reality of trading. I think all of you will agree with me 100% on that. And so saying all that, what I strive to do every single day, as you all know, is construct the S&P, the SPX ES chart, the SPYs on my quad platform, the SPX and the ES E-minis on Thinkorswim, as well as on investing.com, is provide a very, very clear idea, a transparent look of what exactly can happen. And in most cases, it does happen exactly the way it is. I don't need to, like I said, I'm beyond having to prove myself because it's been consistent on my structure of the charts that I draw, the relevant reference points that I'm drawing these to, because you can't be going way too far back. You got to go for the last critical low, if you want to call that. And in this particular case, it was around the North Korean missile nuke test type of thing. And that allows people, traders, who are a little bit focused and who follow charts, because if they're not, they're basically doing nothing. To not basically doing nothing, they're basically getting completely blown out of the water. And these particular tactical charts which every single line and every single level and every single pattern means something, especially if you're a real trader. A fake trader basically doesn't care, likes to put in a lot of comments and just keeps on chattering away about this and that, what can happen. It means nothing to us, okay? Because what we're going to talk about the first part of this ACS session is the actual logistics on the ground. Remember, this is urban warfare, all right? This is urban warfare. And like I always like to say, this is like the SEALs and the Marines out there, and our infantry out there fighting the hand-to-hand battles. Okay, that's really what's going on. So you got to have a lot of reconnaissance. And these tactical charts, for a better choice of words, are pure precision reconnaissance maps. And without these maps, you don't know what the heck's going on. I wouldn't know what the heck's going on. And because I do this all the time, it's kind of become second nature to me to look at it, to find those levels where we can have the bounces, where we will have the sell-offs. And as you all can see repeatedly every single day, that's exactly what happens. Because look, I've said it before, I'll say it again. Forecasting is tough business. It's really tough business, especially in the volatile markets with a lot of flack coming in the form of, using another battle term, friendly fire hitting us, a lot of unfriendly fire hitting us, whether it be international news like the North Korean stuff. In coming months, we might be, getting into one of these North Korean situations with Iran, to be honest with you. So, and then you got these political news coming out of DC with policy. With all the healthcare, Obamacare repeal, which they're still trying to get done, the tax reform stuff. So there's a lot of stuff hitting the markets right, left, and center. And the algos and the programs and the big institutions who run the market, really, they have predetermined levels where they're going to take the market and where they're going to bounce it. And whether it's good news or bad news, what a normal retail trader likes to think it's good news or bad news, because they're just reading the headlines. They're not quite understanding what's underneath it. They're just getting swept around like on the wild seas, you know what I'm saying? And even for us as active traders, we even with these extremely powerful roadmaps that you guys have in front of you that I'm producing on a real-time basis all through the day, it's still difficult because the speed and the ferocity of the movements are literally in seconds, right? I mean, let's face facts here. Now, the reaction time can sometimes be somewhat delayed, and you could be late on a 40% move. Those SPX puts that we bought, they went from $1.45 to 370, but did they go up in a straight line? Absolutely not. They went from $1.45 to $1, then they went from $1 to $1.30, and then boom, they exploded. And that explosion caused it to move higher, went into the $2 range, by the time it fell down here, it probably lasted 1 second. So, and at that point, the highs of the day on the September 20th, so those were today's, okay? Because these are strategic trades here. We're not going to carry these forward because we want to see how the day pans out. Like I said, it's a 3-wave move, as I've explained every single time on the Fed day, and we want to see how the third wave pans out. And this is the real-time chart you're looking at, so you can see a little bit of the red lines coming up. But we wanted to see where this one, this was the close right there, hit exactly my uptrend, one of my uptrend lines here. These are the fan uptrend lines, if you want to call it that way, fan lines, and that's exactly where it hit. I mean, it's just mind-boggling how accurate they are in the way I structured the charts. And they're only accurate to this high degree of precision is primarily because the markets are completely robotic. That's it. That's the truth. All right. But the way I structure it, you do it the right way, and you do a bunch of these SPX trades or intraday, we're talking about the indexes here, indices here. You might lose on 2, but you'll win on 4, or you might lose on 1 and win on 2. Whichever the case, that's trade management and how much time you can devote to looking at the charts as well as reacting to my alerts on a timely basis. You can't just waltz in and say, okay, I'm going to buy it, and it's like 30 minutes late. And it doesn't work like that on an active trading. So they went to a high of $4.65. How you like that, huh? They opened the day at $1.55. These were the 2,500 puts that actually we had prior as well as got into it today. Think about it. It didn't happen in a straight line, so So a lot of new members will be listening to this. They're looking for very, very easy answers. Yeah, there are easy answers. The easy answer is that if you do one of my swing trades, you have an 80% plus probability that it's going to be a huge winner. If you want to be an active trader and you want to waltz in and basically think that's a cakewalk, well, you're going to get smashed out. But if you react to my trades on a real-time basis and as well as keep an eye on the charts on your side, similar to what I'm showing you, then you will have an 80% probability of winning. That's a given. That's a given. Because you'll be able to react fast, get out of it, or take the profits quickly, or whatever the case may be. So, saying all that, what you can, the other thing which I always keep on thinking when I think about my members is if you guys don't have a platform, especially this one, which is the simplest one to use, investing.com. It's free. You subscribe, put your email in there, you sign in. If you don't have this in front of you when you're trading, this one and think or swim, but this one specifically, especially in these markets, then I don't know what the heck you're doing. People come and tell me, well, I'm using E-Trade this and that. Okay, great. I'm not putting, they got great platform. I used to use E-Trade for years. But the point is, I didn't like it. And most importantly, if you are using a platform that doesn't mimic or look like mine, then how the heck are you going to manage your trades based on my precision structuring of these charts? It's such common sense. And even now, I'm sure there's a bunch of you out there who just don't have the same. And this is a free platform, for God's sake, okay? Same platform that you are looking at the same chart. I don't know what to say. So the key message out of that is that if you don't have a charting platform that mimics or similar to one of the ones that I'm using, and primarily the ones which are available to everyone is Thinkorswim. You can always have an account with Thinkorswim. Use the charting platform, which is brilliant. It's obviously far more complex than this one, investing.com. So let's just stick to investing.com. If you're not using investing.com, for example, then you have no frigging idea where the levels are and what you're seeing. So just for your own benefit, do what you think is right, or do what will make you a lot more money and help you. That's all I got to say. All right. So because I've said this before, and yet sometimes when I talk to people, they say, "Oh yeah, I don't use investing.com." I mean, great. I'll tell you one thing, man. Common sense is the most uncommon, scarce commodity in the world. Okay? Believe me when I tell you. In life and in trading. So, saying all that, number one, extremely volatile markets. You're going to see enhanced, increased volatility day by day. You're going to see whipsaws and patterns changing in a dramatic fashion very, very quickly. My roadmaps are extremely precise. I have drawn them with arrows, which is basically the baby version of showing these things. Because anybody who's somewhat of a chart reader knows very well that when it's at the bottom end of the channel, I'm going to put an arrow there. There are intermediate channels along the way. I even put some captions in some of my things. This was the post-Irma impulse breadth thrust. Difficult words, I always say. The big gap up and the run up, the the bull the bull flag. This is the wider channel you're looking at. Nothing difficult to understand about this. These are the levels that the market can fall to. Got to draw another one here, which would bring us down to the 2400 level. Seems crazy, but it's going to happen. Trust me, sooner than you think. That's a 100-point drop, almost. Well, we're not at 19 yet. That's 24.19, right? Remember, this is the critical line on the sand, and that's a 90-point drop. Let's say 10 to 10, 90, yeah, like 90, 95. Let's call it 90-point drop. So that's a 540-point drop on the Dow. Heads are going to spin. They're going to say that the world's going into a depression, blah, 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 the same stuff. Okay? Everything's finished. But believe me, there could be some credit situations in the US and overseas, which will just be a black swan event, unquantifiable. There could be a massive rejection of a comprehensive tax reform plan. It could be North Korea really, like, I hate saying this, but landing a missile, like, let's say in a unpopulated part of Japan or something like that. A firefight with North Korea initially, that's what markets will do. They'll drop 400-500 points really, really quickly. Okay, so all these charts are showing you all these different levels where the markets will bounce from and will they drop. Now, it's so you're at least you know what the roadmap is, so you know how to react to it. You don't be like, oh, we're down 50 points. Oh, what's going on? You know, just the way the rest of the universe does in the universe of retail traders. Look what they do in stock twits. Look what they do in other trading forums. All emotional freaks. Great people. Boy, they're emotional freaks. You know, every day the market's going to go higher. Yeah, right. Every day the market's going to go into a bear market. Yeah, right. You know, it's the same old talk over and over again without any rational technical basis for that. It's a purely technical market. It doesn't matter what my opinion is. It doesn't matter. I'm just trying to get this completely parallel. It doesn't matter what do you call it, anyone's thought processes are. It's a very difficult market, period. And in between that, you can do multiple swing trades. You can do short-term intraday type of trades. And I try to show as many trade alerts and stuff as possible so that people can do whatever they need to do. Because we have a combination of different types of traders. We have active traders who are closing out positions at the end of the day. We have swing traders who are buying something and sitting on it. We have traders who are doing a combination of both. And then we have traders who are doing maybe very fast 1 or 2 quick trades during the day and then not doing much. So the way I look at it, there are tons of great ideas on the market. However, the fact remains that I can't just give out. I could give out just maybe 2 alerts during the day and just put out a couple of charts and just go away. But I try to engage with you as much as possible. And this is probably the only service out there, which I've said it before, I'll repeat it again, which provides a real-time, ongoing. It's almost like a mirror trading service. It is. You're not exactly mirroring every single trade that I'm doing, but every single trade that I'm doing, I'm sharing. And the fact is that we are mirroring because every single movement in the market is being shown clearly all through the day. So I just want to be clear about that. So here's another SPX chart, well, a futures chart, which shows you the wide range that we can travel in, the minor range that we, look how congested this is. This is literally a 5-point range, right? 24.97, 24. on the top end 2506, a 10-point range. So you got a 10-point range here, which is causing havoc with individual stocks. You all know what I'm talking about. It's a 10-point range, for God's sakes. Okay, so these are the most difficult, believe it or not, just the real logistics on the ground type of situations that one can trade in. Why is that? That's because we're not getting a big breakout. We're not getting a big breakdown. We are moving in a 10-point band very, very rapidly, and that's causing any, you get into a quick short trade or you get into a long SPX trade. Yes, they work out over, when there is movement. But if you really think about it, the tighter the trading range is, the more difficult it will be for you to scalp any type of decent profit. Even though we're managing to do it, it's very, very, very difficult. Now, we had a range like that here. We played it very nicely. This one actually had some wider fluctuations compared to what we are going through right now, which is so tight, it's crazy. And then we dipped, the Fed dip, right? Because now we're zoomed out on this bigger chart. So it's not as magnified as the previous one we just saw. But if this didn't happen, then those puts wouldn't have worked out, and certainly the calls itself from here worked. But otherwise, they're kind of stuck, and you can just take minor scalps. I hope I'm very clear with everyone on that. Hi, Exita. So bottom line is that these type of movements are killers, right? They're fantastic, but they only come off extreme bottoms, or, as I correctly pointed out, this was a bear flag, then the big drop. We did well with that. And then it goes into a zigzag sideways pattern. Again, difficult to trade. And then the risk bet that Irma would not, whatever the case, we're positioned very well, not in a big heavy way, but in a moderate way, as you know. Pre-Irma, the pre-Irma financial insurance panic, insurance companies were selling off, banks were selling off like crazy. That's when Goldman was basically completely falling apart, as if it was the end of the world. Look where it is now. But that was it. That was a trade we worked out great, because this was the Irma gap up and go back to the trading range. Now everything is happening in a space of 3 to 4 days, so it's not like you're looking at a chart here that is. This was from was from August 29. So you're talking about 3 weeks. You're talking about 3 weeks from here to here, and so much has happened. So what I'm getting at, the thing that I want to impress on all of you, the realities of trading and investing in this type of market means, number one, you have to be very selective. Number two, you can't have overloaded positions. You can have overloaded positions if you're coming off these type of powerful reversal bottoms where there's a continuation process. And of course, I'm not showing the internals down here, but but candle after candle on a daily basis is telling you that the market wants to go higher, and then it rips higher just when you think it's all over. And then comes the North Korean move. So bottom line is that number one, you don't need to be overloaded. If you're overloaded in one single position, chances are you're either going to make a ton of money or you're going to get blown out of the water. I regret a lot of the times why I'm not overloaded in certain positions, which I'm very, very heavily convicted on. But what does my conviction mean when you wake up the next morning and futures are down 10 for no reason? I mean, for some reason. Back to the grind again, to cost average and run with it. And, it doesn't feel good when you're in a position it opens down, right? That's a given. So having a somewhat diversified trading positions, and the high, you have to segment them down. You have to have the Teslas, the Nvidias, the Apples, the Netflixes, whatever, the high beta momentum stocks in one category, which which basically pay the bills big time when you get these big run-ups because they keep on gapping up every single day. So the high beta positions in one, and then you got the boring swing ones, which take a couple of weeks and then pay the bills, whether it be Juno, whether it be PBYI, Sarepta, whether it be small stocks like, well, I've recommended quite a few of them. You know, stocks like Halo, you name it. You know, there's about 6 to 8 of them that have been recommended, which you can basically just sit on, let it go, as long as the charts are permitting, because they don't move around like the crazies, the high beta momentum stocks like the Teslas, the Amazons, the Googles, and all that stuff, and the price lines. Price line is actually more of a swing trade in some ways if you catch the right bottom, like we caught it, and it normally it goes on a 3-day run. So the swing stuff is one, the high beta ones, which needs the highest amount of management, and then and that's really what it is. So you can have a combination of both. I can't tell you what you need to do, or you can just have, or you can just decide to just play the high beta stocks during the day or on a 1 to 2 day basis, and not bother about the swing stocks. That's completely up to you. So, talking about the broader channel, this is where we are. Upper end of the channel is 2545. Which translates into 2550 on the S&P 500. Are we going to get there? My gut tells me yes, but my gut also tells me that we could be doing, well, from here to here is minor. You know, you're talking about a move of 6 points, right? 2504, 4, 9 points. That's a 9-point move on the S&P 500. But can it do this? Sure. Can it go all the way down here? Hey, anything can happen. I mean, once we break below the post-Irma impulse gap open move, then things start to get dicey. And that's around the 2472 level. Now, all this is very clear on my charts. You guys to spend time. You don't need to spend time. You can just look at it. It's all done for you. Just have to look at it. So once you break below these levels, all of a sudden, this comes into play. And a panic sell-offs can culminate into a drop back towards these levels here. But those are, you know, I'm not going to call them low probability trades because nowadays anything can happen. Anything can happen. And the machines are vicious. They'll just make it happen. So, yeah. And people say, oh, well, what do you think? Well, I have my thoughts, but I don't really think much. I'm just following my charts. And you guys better do the same thing or you're not going to survive. Period. In the meantime, we seem to be in this range here, upper end of this range, which I think is a short-term top in the market, in my opinion, which is around the 2520 level. This burst. And I think this comes about by, and again, this is a 16-point move, right? On the E-minis, call it 16 points on the SPX. We have a guest here in the house by the name of Jose Carmona. Well, welcome, Jose. The first part of the session, this whole session is recorded, Jose. Can you hear us, first of all? And can you see the screen? Jose or Jose? I'll call you Mr. Carmona. That sounds more royal. Jose, can you hear us? Jose, can you hear us? Yes? Jose, can you hear us? Okay, forget it. So, because we have limited time here, we can. So this is a 16-point move. That's roughly about another 80 to 100 points on the Dow Jones, right? And we could get that by next week for two reasons. One, window dressing, which is the year month-end markups of portfolios by fund managers as they stuff in the big high-performing names to show in their books. Want to know the whole definition of window dressing? Just Google it. Okay, go to Investopedia, type in window dressing. It's basically where fund managers, mutual fund managers, institutional fund managers, pension fund managers, primarily mutual fund managers, stuff and try to show the names in the books which are the best performers for that particular month, right? So the same names that have performed very well, you're gonna see them mark up. In other words, the high beta names are going to be added to their books to create alpha. Alpha means excess returns, so they look good. So even though they might not have owned a certain stock, let's say Tesla, they'll buy a bunch at the end of the month just to show they owned it. It's just the way it works, all right? So that window dressing move could bring us to the upper end of this channel. Do I think we hit the whole move up here? I don't. But who knows? We could have some real concrete details on the tax reform plans, which is coming supposedly first week of October. So we could get this by the first week of October. How about that? But for next week, between window dressing and the Obamacare repeal finally going through on the ground. Okay, somebody better just mute because I'm just going to mute everyone. All right. The reasons behind the move here next week is the Obamacare repeal finally goes through, the Graham-Cassidy bill. So that gets out of the way. Market gets about a 100-point bump. And that brings us, if you look at the charts here, that is perfectly symmetrical. A pullback, minor pullback would be fine. So this channel remains the intermediate channel that the markets travel in. Okay? And this, in my opinion, maybe culminates into the first week of October, because the second part of October, middle of October, you're going to get, in my opinion, based on everything that I've seen, and there are technical reasons behind it too, end of October is the end of the fiscal year for the 800-pound gorilla in the financial industry, which are mutual funds. Okay, so they do a lot of adjusting around in their books, adjusting at the end of that's the end of their fiscal year. So you're going to get a nice slam down sometime by mid-October. All right, that's a given. And plus, at the same time, the Fed's basically going to be winding down their balance sheet, and that is going to cause some turbulence in the credit markets. I'm going to cover that stuff on my next ACS session this coming weekend. So bottom line is, so that's all coming in October, mid-October or so. So, so that could be the top, then a big pullback, and then I think we end the year on a nice note. That's my opinion. Saying all that, let's move on. So we have covered this chart. This is the zoomed out version of what we've been playing, and it's been picture perfect. You guys know that. And then this one is the zoomed in version, which you can use on a daily, hourly basis. Every single one of these levels was predicted prior to them happening. The movements, I repeat, are extremely quick. So if you're going to trade the indices, you better be glued to my charts or have a platform that are mimicking my charts or having the time to look at what's going on literally on a minute by minute basis, or else don't actively trade the S&P 500 during the day, especially on a Fed day or any other day for that matter, because you're going to get slammed. We have a high success ratio on our SPX trades, longs and shorts, calls and puts. And even then it gets tight to difficult, especially on constrained or tight range volatility like we saw here. These tight range volatility markets are not the ones where you can scalp what? $1 of an S&P, and then by the time you try to sell that up $1, you're going to be down $2. These are the days where you could trade, which we did. Now this pattern, like House said, looks like a inverse head and shoulder. Okay, that's your left shoulder. The right shoulder comes down here. We shall see. It can either be an inverse head and shoulder, or it could be a wham bang double bottom retest overnight. Because remember what happened. The Fed, if you notice, the banks, that's why I didn't push Goldman after it hit my initial target around the 230 level. What did Goldman do? It was up like boom, $2.50, right? Great. We were long Goldman prior. My Goldman chart was very clean. You guys know that. It showed that we would basically get up to that range. I mean, it's so picture perfect. It's not even funny. I'm not, you can make these things up. You can make my charts up. I mean, it's just like I'm looking at it on the screen. I'm going to drag it in on the closing shot on Goldman into, trying to do that right now. Bear with me 1 second. It's too many charts on my screen. My computers are getting tired. They're running on 24 gigs of RAM and they still get tired. So imagine. Okay. It's frozen on the other side. Okay. I fixed it. Did I fix it? Come on, please. All right, it did it. So it's going to take me a minute, but I'll show it to you guys. Obviously, my members already know. So anyway, so we could have a big fat like this, because what's going on now is the emerging markets might start to get, so anyway, talking about Goldman. So if you notice, shot up big time, but the Fed said, yes, they're going to raise rates. They're going to basically start winding down their balance sheet, but they were still a little bit dovish. So what happened? Financial initially rallied and then boom, gave it back. Nothing big. They know rate hikes are coming, but the Fed didn't go out there this afternoon and say, we are raising rates in a big way starting in October for the next 6 months. Then the markets would initially go higher and then fall hard. That's another day's story. I'll explain people who are my advanced coaching sessions as to why that happens. The only thing that I'll tell you, it's not the fact that rates are going higher, it's the speed or the rate of change. The rate of change, if it's dramatic, if it's very quick, markets get very nervous, credit markets go into a sharp correction, pulling down stocks, and you have a nice 500-600 point correction on the markets, and you guys are all sitting there going, whoa, I didn't expect that. Why they said raising rates are good. Well, it ain't that simple, kids, all right? There's a lot more to it. So, 1 second here. I am trying to. Bear with me 1 second. So, banks are not, you can certainly trade them, but you can only trade them through charts. You can't trade them fundamentally on a one-way run-up. Okay? So, have a little patience. I'm just putting it up on the Twitter feed, and then it'll show up on my side. And I want people to remind themselves of okay, here we are. Come on. So here's your Goldman. Beautiful. So if this chart is not picture perfect for it as a precision trading roadmap, I don't know what the heck is. All right, and I've walked you guys through this big time. This wasn't adjusted fully because the pivot line in this particular case, for ACS students, they know exactly what it is right here, 228.79. So this dotted line should have been moved up here, but I was too busy today. I don't even know why I draw the dotted line. So that at least I actually put the dotted line in, a yellow line, so that people know that's the pivot. So here was the Goldman big buys. Here's your big inverse head and shoulder, double bottom, dragon bullish W formation, right? It's a W formation. bull flag, and that's it. Is it possible that it completes the pattern to 236? It is absolutely possible. No question about it. 236 under pattern symmetry is doable. Is certainly doable because the bull flag pattern here, or the bull channel, I should say, is still intact over the 34 moving average of 227.69. So if you're trading the charts, you're going to be fine. If you're trading your head, you're done. Okay, that's it. I don't need to remind you guys on that. So this is your channel. It's actually kind of came down and touched the lower end of the channel. If it breaks below these two lines, which are the 34 and the 50, and this is the hourly chart, mind you, it's the what we call the trader's tool, then you got a support at 225, and it possibly creates another W type of pattern. If it breaks that, see you later. Goldman's going to come, fill the gap here. Remember, these shaded boxes are the gaps. That's going to be 218. So just by using this chart alone, you don't need me. You can trade Goldman on the side. I don't trade Goldman every day. Off extreme positions, I do. But I don't need to be trading Goldman every day. I'd rather trade the high beta movers than Goldman, which is a high momentum stocks in its own right, but not necessarily a $5, $6, $7 mover. Those are the ones which pay the bills. So I could spend an hour on this chart and give you every reasoning why every single line was drawn the way it is. But you want to learn, take that extra step. I've said it. I have no qualms about saying it. Spend a few extra bucks, sign up for the advanced coaching sessions. My job is to put these stuff through, guide people through, but I cannot be on a real time date during trading hours, be somebody's kindergarten teacher. Can't do that. You want to really learn the skills? Do it. Many haven't, and unfortunately they suffer, especially in volatile markets, on any markets, but especially in volatile markets. They get blown out. They're in a position, they don't understand what I'm putting out on the charts. They're wondering, oh, you said it's going to go there. That is the few words that you should eliminate from your vocabulary. I do not control the market. These are not my levels. I structured the chart so I show you the levels you can trade off, long and short, primarily long in most cases. I don't control $1 trillion going in and out of the market on a weekly basis, or $500 billion. So if anyone comes to me, they can certainly, moan and groan a little bit. But if a trader basically says, you said it's going to go there, but it didn't go there. Well, 80 to 90% of my stocks go exactly where I said it's going to go. But it might not go exactly at the same time I'm saying it's going because of volatility. So if people have that type of notion, then they need to really get in there and maybe get a monkey wrench or something from Home Depot or Lowe's and fix their head. That we call mental calibration. The charts that I'm putting across in front of you guys are the roadmaps. You have to manage your trades accordingly based on where I'm showing what it is. Now remember, SPX, RUT, QQQ charts, indices are fundamentally different than individual stock charts. This is another picture of the same of the market of the E-mini futures, which are the best tools to use in managing trades. Look at this. Is it a possibility that we complete this entire pattern? Absolutely. And it's not even much. 2,500 to 2,487. You're looking at you're looking at 17 points. You take the 17 points, you're looking at roughly 100 points. The drop from here to complete the pattern, which I would love, to be honest with you. It would be a fantastic buying opportunity. Multiple solid supports at this level. And if we break that, we'll see you later. We're going down. And going down meaning you're going to go down another 20 points. S&P 500 moves in 10 to 20 point increments. Period. Like Sean Spicer said. Period. Okay? That's it. On a tight range day, they will move 5 points. On a wide range day, they will move 10 points. 10 to 20 points max. 30 points is out of the norm. 30 points means the market, the Dow Jones, is moving intraday, and it certainly has happened many times, in a range of 200 points. It could be down to 100. We've done a lot of these, right, guys? Down 100, up 100. It's far fewer, but when it happens, we have a field day. Because these tactical levels are engaged, we engage them at those points, while the rest of the crowd out there, the so-called emotional monkey on a hot tin roof traders, right, which most traders are, they're looking at prices like, oh, we don't know what's going on. They're just doing the stupidest things ever. And we all do stupid things, mind you. Except the frequency of our stupidity is far less, in fact, almost non-existent if somebody is very tactical, than what's out there. So these type of days, down 100, up 100, are few and far between. But it happens. It happens. It was happening a couple of times a month, but then it kind of, we went into that sideways range. But at least you know where we can drop, where we can bounce. But more importantly, I'm not leaving it to you guys to make a determination. I'm there consistently in the form of my charts, in the form of my comments. So you just have to look at them and say, okay, this is where we put the arrows, and this is what it looks like. You want to know the reasoning behind it and stuff? Well, for that, you sign up for the ACS. All right, now let's take the same picture on the E-minis here. Okay, this is the Thinkorswim version. This is a 4-hour chart, which is extremely important. So this was drawn and presented to you guys much earlier, well before the Fed, and right there. So here you have a large rising wedge, a large one. Upper end of the wedge is 25.12 or thereabouts, which translates into about 25.17 or so on the S&P. So not much room left, if you ask me. This was today. We came wave two. Wave 1 was higher. Wave 2 was sharp down, blood red, and guess what? It engaged. It engaged the infamous 50 SMA, the 50 simple moving average, right there. You can see that right there. So anybody who does not have the luxury of clueless day trading charts was basically freaking out like they always do and saying, that's it, we're going down, we'll be down, the Fed's finished, I mean, whatever they say, I don't really care. Bottom line is, it's the same old primal yell of emotions, which serves nothing. And the reason why I emphasize these points, because these are such critical mental habits that if people change, they would be in better shape. That's why I keep on using the word emotional and tactical. So here's your range we broke out of. That range we broke out of on 1 o'clock on the 15th. Look at the date up here. 1 o'clock on the 15th of September, we broke out over this range breakout. We were there, position. We went up, and then at 1 o'clock on the 18th, which was Monday, we came and retested that same range breakout. You can't make these things up. This is how it works. Look at that. This thing, I am positive, freaked out a lot of people. Not in our club, but other places. All it did was come and retest the range breakout right here, right there. You can see that right there. Right there, it did that today. If we broke the 50 SMA, you know what I say, the likelihood of a further fallout, because at that point, it'll break the lower end of the wedge. At that point, we have a nice gap here. And that gap, ladies and gentlemen, is on the 265 to 2460 to 2070 level. You're talking about a significant drop. Can it happen? It can still happen. Never say never. Always be prepared, or at least know the roadmap. That's the game of preparation. We're not mutual funds. We don't have billions of dollars, millions and millions of dollars to spread out and put huge defensive positions here and there. We're all trading with a limited amount of money. Trading money, risk capital. Okay? So bottom line is, right now, futures are down about $1.50, $1.75. As long as we keep holding the 24.94 level, you guys can see that, then we are good to go. Do not assume anything in this type of market, please. Tomorrow we could be down 200 points for all I know. Right now we have we basically have a very sharp reversal hammer. Looks like a Chinese firecracker, right there. This is big, but it wasn't green. It wasn't green. Does that mean anything? No, but it's nice to see a powerful hammer reversal of this magnitude and then green. Because if you notice, the whole 4-hour volume candle was red. That means primarily they were all sellers into the rally. How you like that, huh? Right there, you could tell. Anyway, I don't want to spend half the night explaining all that stuff. Whichever the case, there's nothing wrong technically here as long as we are holding above the lower wedge or the uptrend line and the 50. Stocks. Oh, let me just show you the SPX, which was constructed, and you guys have seen it many, many times. Let's take a look at the daily. I always look at the daily. The daily is beautiful. It's beautiful because look, the daily upper end of the channel on the SPX is 25.65. We are still in a bull flag formation. You can see that. That's a bull flag, ladies and gentlemen. It's still there. On the daily SPX, the reversal hammer is green. So even though we get what this is telling us as traders is that even though short term we'll get gyrations, over the longer term, not years, that used to be the case back then, but over the next, going into the end of the month, first part of October, we're still inclined to go higher. That's the way us tactical chartists interpret these things. So this chart is also, look at that. Let me just zoom in. These are consolidation channels, not one way down, down, up, down, within a channel. People freak out. They start, they really start freaking out. There's like silence. Nobody's in the chat room. I mean, God knows what they're doing. Maybe they're ordering through Alexa more adult diapers. My famous last words. That's what they're doing. That's what a lot of emotional traders are doing. They're basically telling Alexa, please send me some adult diapers. So whatever the case may be, all kidding aside, this is still good to go. The 5 SMA is still good. This is all good. 20 crossover. Well, I don't want to get into it too much. But net, it's looking just fine. Again, we break below 24.55, then obviously we are, that's when we break that uptrend. And that's 55, that's 300 points here. So we still have a 300-point cushion and still be on an uptrend. It's pretty simple to see. All right. Let me speed up here. So here's Apple, for example. We traded the stock long. We have traded it short. We did a scalp trade here short. We were short the other day. And even that short, which from the time that I got in, was up from $1 to $1. From 80 cents. The puts, and remember, they're not today's. They're Fridays. The ones that we did, to $1.70, $1.71. All you had to do was simply keep an eye on this big fat red candle. This is even the daily. This is not even the hourly. My Thinkorswim chart, which I showed you guys, was far more effective. It was Just fantastic. So here we are, the 4-hour chart that I showed you guys. I showed you the daily too. The daily was this right there. So when I shorted up here, and I should have shorted earlier actually, but anyway, just forget it. We're doing some great stuff on the other side with a bunch of other stocks. So looking at this here, this red candle was just blood red all the way down, and I had drawn the lower gap fill, right? Big fat line. And guess what Apple did? These things don't lie, guys. It touched it, kissed it, and went up. Does it mean it can? I was hoping to get a bigger bang for the buck if it came to the lower end of the channel, 150, 250. But touching and retesting the lower gap right here, this gap all the way back from late July was good enough for the stock to turn around. Right there. It could have slipped a little bit more if the market had pressured more, maybe, but for Apple to slip another $2, that means that would really affect the Dow in a big way. And there were other stocks holding up the Dow, which is called the market dynamics of the indices. I explain all that on ACS sessions very much in detail. In fact, we'll be doing that this weekend for a bunch of people. Is when you have the Caterpillars and the Lockheed Martins and the Boeings and the Goldman Sachs, all Dow components, moving up. It's tough for Apple alone to pull the Dow down, or the Dow to pull to Apple down. So this was good enough for a nice sizable bounce. So this was a daily, which I showed you guys. Forget this. This hasn't even curled up yet. So this could again slip lower. It's not out of the woods yet. Out of the woods is 150. That's out of the woods. That's when you buy hands down, which we did back then. But this chart is very, very clear. And so if I put this down on a 4-hour chart, you get to see a little bit more detail. That's called zooming in, right? So if you zoomed in, look, all of a sudden that gap's disappeared, right? It's there. You can see that on the daily. Look, you can see the gap on the daily, this gap fill. This is the beauty about tactical analysis and tactical trading and the way I structure my charts. Look, a lot of people have technical analytic charts out there, and a lot of them are great. But I always say some of them are so simple, it's pure stupidity. And some of the biggest names, I won't name, just in case they sue me. I look at their charts, and I'm like, man, they just basically put out a naked chart and say, okay, it's going higher. Oh, great, exciting. Really, I'd pay anything to follow somebody like that. Yeah, it's just going higher, as if. So there's no structure on top of it. And there are some services out there been around for a long time. We basically throw out these charts and that's it, it's going higher. Okay, great. So the bottom line is that it just doesn't work like that. But hey, when people want to believe that garbage, it's fine with them. So so this is purely structured. You see the consolidation channels. Okay, you see the consolidation channels. You know what these lines are going to hit. Max move on Apple is this downtrending 34 and 50. 159, 160. Maybe if it breaks out above that, boom, it's going to go back to new highs. If it falls below that, it's going to come back and test this again. Whichever the case, you don't see, this is the gap fill that you saw on the daily. But once you zoom into the 4-hour, then you see, then obviously, you're zooming in and you don't see that gap because this happened. Anyway, you know what I'm talking about. So at this point, it touched upper gap, and then there were 3 minor candles. Now, should I get super excited with these 2 minor candles? But there was nice volume, the decent short covering volume, no question about that. Look at that. That was 15 million shares, 16.7 million shares right there. I personally wouldn't get excited. Even though somebody will say, hey, you should get excited because this is a 4-hour. You get a crossover on the stows, on the full stows. Yeah, you can. You certainly can, no question about it. I don't see anything wrong with trading this up towards the first resistance, which is 157. So I'll revisit it tomorrow. If I see this moving above these lines, I'm going to show it to you guys. And you guys should know by now, if it crosses over the 5-day, it's going to go to the 20. So that's a nice move. You can get 2.5 points on Apple calls. That's a decent return on the money, right? Whichever the case, these stocks are structured. The charts have been fully structured for anyone who has a driving license to drive these charts. So, and here's another version. I don't know what more I can offer. Here's Amazon. We shorted Amazon. Okay, I made a puny amount of money on Amazon. Shorting Amazon, I in fact shorted it off this break here. I can't remember. Not this one. Today was the 20th, so it was back then. The first when I did the short, it was $3 and change. It jumped up to almost 6. Took a little bit off the table. After that, it was just a no-go zone. This is what you call the premium killers, just so you know, the realities of options trading. When a stock does this, okay, all it's doing is eating away your premium. It's not dropping. It's hitting these big support levels, and it's Amazon. So, rule number 1, don't try to short this big behemoths unless there's a real market breakdown. Amazon looked like a head and shoulders on the daily and stuff, but you know what? And I showed that too. The fund managers who buy the Amazons, the hedge funds which trade the Amazons, they never give up on it. A lot of retail traders think, oh yeah, overvaluation. Yeah. Half the retail traders don't even know how to count. In fact, they don't even know how to do percentages. You guys know that. Okay? And they all want to be top-notch Wall Street analysts in their own time. Maybe a good time to do it was when they're in the morning sitting on, you know what, maybe that's the time you want to be an analyst as I call it. Stop being an analyst, all right? 14 years plus on Wall Street. And I tell you, I know more income, read more income statements and balance sheets than all of you guys put together. And it still doesn't make sense. To me, it does. I know when they like something. I know how their growth valuation models are. And everybody's talking about PE. So if you really want to be a PE analyst, good luck. You will consistently lose money in the market. So case in point, when you short these monsters, get out of Dodge quick. And now this happened. What is this telling you? This stock most probably is going to go and kiss the downtrend line right here at the 980 level. For Amazon to go up $10 and touch the downtrend line here, and this was your last supply zone where the big sellers came in, you got a good trade. I recommended the trade right off the bat. So I'm going to take a couple of quick questions, and I think I've explained a lot of the little nuances on things. There's your Nvidia. Nvidia is down more after hours because the last 5 minutes, the news came out. That's why I said buy AMD. If you see my trade alert, that Tesla apparently has replaced Nvidia and working with AMD. That means AMD's it's up nice after hours, but we shall see, because the level that it is again comes into play, and the news came out at 350. Talk about manipulation. Is the level that comes into play again is here. If it falls, the biggest level to buy it again is this breakout zone. Remember, this was the infamous breakout that we all enjoyed. So that big fat breakout that I was showing all the way from here and lower, that it was going to test the highs. A lot of our traders actually participated on the Nvidia trade in multiple cases, but then a lot of them just SOA'd around. Well, good luck. I know that I can't change. So 174 becomes a hugely powerful buy zone on the stock again. Nvidia is not going out of business. It is a frontier of artificial intelligence. So the bottom line is I can draw this. There you go. That level of contact is where we are right now after hours, right here on the knee-jerk reaction to the AMD news. Is it possible it does that? Absolutely, because this is basically a large bull flag or consolidation channel. If it breaks below this uptrend, uptrend line or the green line or below 172, then you got some lower levels to contend with, 162. Anyway, one step at a time. But lesson one, don't try to be an analyst. And two, these type of powerful powerhouses never fall out of favor unless somebody comes and replaces them. All right, question time, and please make it quick because it's been a long day. Anyone?
Hey, close, Lamont, it's House.
Yes, House, go ahead.
When you hit that on this Nvidia chart, when
Yes.
you get down to that 180,
Yes.
is that when you start to scale? Because I can obviously see that that could bounce there, but if it doesn't, is that when you start to scale in, or do you just
Okay,
wait?
I don't look at it that simply. I'm not using this one particular chart for all my trades. I'll be looking on the TOS side and looking to see the internals to see whether or not that's going to be something that's going to hold. You know, it's basically you're trying to get a high probability whether it's going to go to hold or bounce or whether it's going to go. So it's a couple of factors that come into play. One is the overall candles and the chart structure. Number two is, oops, one second. There is. My Nvidia chart has been drawn here. So I'm going to go to this and I'm going to look, these are the channels that have been drawn and shown to you guys certain times. Look how beautiful this move is. So here we are engaging the 34 moving average. You see that on the 4 hour. The 4 hour is a very powerful time frame to look at right there. If it falls below 170, if it breaks that, it's got the breakout line to contend with, which is 176 or 175.53. If it breaks that, you got a major support level at 173.84, which is the uptrending 50. If it breaks that, then you're looking at the lower channel, which is at the 167 range. Now, how do I know it's going to go all the way down there? Well, number one, I'm going to be looking at the volume flow. Number two, I'm going to be looking at a very simple indicator, aside from my McClellan oscillators and all that stuff, that I only look at during extreme market sell-offs or market blow-off tops, is my full stochastic. The full stochastic is telling us that Nvidia is probably going to go down a little bit more. The 1 hour is fully oversold right now. You see that? So it's not just one thing. As you become a practitioner practitioner, I should say, of technical analysis, a lot of things are processed through your head, and you very quickly scan through these charts, and it gives you a gut feeling and a tactical gut feeling as to whether or not it's going to hold or not. So it's not just by looking at one structure. I'll be looking at the internals. I give a lot of weight to the 4 hour because that's a very reliable indicator. The 4 hour is still pointing down, but it could very well point up directly as it tests, in my opinion, that 175 range. And because this was the big breakout. Don't forget, Nvidia is a very volatile stock. That's the reason why it's a beautiful trading stock. Okay. And so the bottom line is this is a powerful support. If it breaks below this, and I want to see how the curvature of these lines look, I look at the indicators. I quickly look at my other indicators on one of my other charts on Nvidia, and then I decide whether or not to buy it. But if you want to make a simple assumption, the best buy level on Nvidia, the best, is obviously the lower channel, which is 168. Is it going to be 179 to 168 in one go? Oh, no, it's not. It's going to come here. It's going to possibly bounce hard. And in my opinion, Nvidia and AMD can coexist A-OK because they're two different types of companies. Nvidia's artificial intelligence chips are far more advanced than AMD's. But if Tesla has picked AMD for sure, then obviously they have a big contract in their hands. So AMD's chart has been shooting higher, and that I'll be showing tomorrow. and you can see what's going on there. And this is a 4-hour, but if you look at the weekly, it's a really, at this point, it's a pretty damn good looking chart because you got a wide bullish channel here, and its breakout will bring that stock up towards the 16 range. It's a $13 stock, not a $130 stock. So options are damn cheap, right? So this is back in play on that news because I normally don't play it, but this at this point it's going to break out over 14, which it already has. It's 1462 after hours, so it's already here. Will it kiss the highs? In my opinion, it will. So that's the best answer I can give you, House. That it's not just looking at that particular pattern, it's looking at many other things in order to. Can you go over, Xita's asking over the Tesla chart. Yes, the Tesla chart is already constructed. This is the only chart that I use to trade Tesla for a long time. Tesla is in very fine shape. Jeffrey's downgrading it to 280 is a frigging joke. They've always been negative on Tesla. And Tesla has always blown past expectations. I do not care about Tesla. I do not like Teslas as cars. Unlike many other people, I really don't care about it. I just think the stock is a powerful trading vehicle. Period. That's as Mr. Spicer told me to say. Period. Okay. So bottom line is Tesla's chart is very defined. Xita, you can basically just you don't need to go all you can see the reference points here. 1 second. That's the high right there. Okay, so if you want to look at it that way, this is your trading range, 388 down to exactly where it hit, where I said buy, right? I said buy here, then it slipped a little bit more, but I said buy again here. That's called cost averaging a bit, which is approximately in the 369, 370 range. So Tesla moving around $2-3 is nothing. So as long as this level holds, you are going to see a bounce. Will that bounce carry it to 388? I don't know. All I know that you will get at least 380 out of it. So that's 7 points. If it does break that, and that's why it's so important that managing your trades require you to look at my charts. Don't have to look at it every minute, but at least you have to have an idea. Print them out, screenshot them. This is the best way you guys can all survive these markets. Screenshot my charts. Do you know what screenshotting means, guys? You use a program like TechSmith, Jing, Jing, which I use to post my charts. Copy and paste. You know, they're all on my Twitter feed anyway. Go into the media section, but copy and paste and put it in a folder or somewhere in your desktop, so you can quickly open it and take a look at it. You don't have to look for it. All right, start doing that on the main stocks that you trade. So this is the clean version of what might happen. Scenarios. Comes here, bounces. Tesla looks like it's up about $1.25 after hours, and it moves up. Level of where it started to really sell off is around the 382 level. So that's your first level of resistance. If it breaks below here, if it falls below here, below 368.34, right there, you see that, then you got the upper gap fill. Remember, this was a gap fill. That's why it's here. So I need to push it out a little bit. 1 second. This chart it's so precise. It's beyond anyone's imagination, unless they're trading it. It's not beyond their imagination because they've seen it happen repeatedly. Doesn't matter what I think, what the news flow is, what's going on. Just follow this chart. That's it. So either does this, okay? Let's say it breaks below this. Then you're going to see a sharp, quick sell-off. That's going to be a sharp one. You can short the stock. That's from the this previous breakout level, right? This was a breakout level. This was a very large inverse head and shoulder dragon bullish formation. There you go, multiple bottom, big fat arrows. What more can you say? Gap open, gap and go. gap and go. I mean, it just wanted to get there. It didn't matter how it got there. It didn't matter there were downgrades, upgrades, traders just saying Elon Musk is a fake. I mean, I don't care. It just wanted to get there, and it got there. Okay, and I said it was going to get there, and it got there, right? And at that point, you don't jinx around. You don't say, oh, yeah, he said it was going to go to 400. Yeah, it's going to go to 400. But the point is, once you get that much profits and it gets there, what are you going to do? Just say, oh, it's going to go to 400, so I'm going to leave all my profits alone. Yeah, great. Then you're basically down to zero. So traders who do that should not be trading. They should just hand in their resignations and leave the Oval Office. How about that? All right, because that's idiotic. Just because there's a price level that I think it's going to go, or an analyst puts a price level out there that we're going to, doesn't mean that you have to basically close your eyes and hold it there, because that might take 4 months or 2 months. In the case of Tesla, it might take 2 months instead of 2 years. So going back to it, if it falls below this level here, it's very clear, the 370 mark, then you will see a quick sudden drop down to exactly where I'm showing, as I've shown, the upper gap, which is 363. So you got a move of $8 down here, and that $8 at that point becomes a major support level. You can see that. There are arrows there. I can't make this any simpler. You will see a bounce. That bounce, if it's exact pattern replication, which we have seen multiple times, will culminate into another big fat move. If the stocks breaks below this, remember, this is a major trend line. This is a major trend line. If it breaks below this trend line, which is in the 358 range, short it hard. In fact, if it breaks this, of course we're going to short it, because it's going to be fast. Boom. It's not going to be like breaking and then, oh, well, maybe I'll just stay around and go higher. No, it's just going to move fast. That's how it works. We love things that move fast because you don't have to wait around holding your nose or going to bed all nervous. You just want to get it done with. The faster a move happens, the better off it is. That's why we trade volatility. Remember my saying, the faster and uglier a sell-off is, and we basically are, let's say, on the put side, whatever, we don't want to be dragging that along for 3 days. We want to drag it for 3 hours. Get to that point, boom, move from there. Just the way it works. Remember, every action has an equal and opposite reaction. On a violent sell-off, of course it didn't go straight down, it did this, you are going to get a violent rebound. I said it, it's just the way it happens in these markets. Accept it. It's the algo gods. Accept it. Bow to the altar of the algo high frequency trading gods, okay? Just the way it works. Anyway, if we do see, this is the bearish picture on Tesla, if we do see a breakdown below the lower gap fill, you are going to come and retest this. There is a big fat gap here. That gap, in my opinion, the pressure of the stock falling that fast will not hold. We will at that point come and test 336 again. And that creates a phenomenal opportunity to buy. Will it happen? I have no clue. But I do know if it happens, it's going to bounce so fast up here and then possibly fail again. It did that 3 times. While most SOA traders just sat around and watched. So, all right. So in summary, what I'm getting at is this, guys. I'm as clear as daylight, okay? This is a tough market to trade. There's no question about it. And by the way, when you look at this pattern, if it does get there, that's a total head and shoulder with multiple left shoulders and right shoulder. And that would be a real, that would be a bearish pattern. That means Tesla is going lower. That will happen if they fail on their October deliveries or whenever they are of all their models that are coming out. All right? It will happen. And that's when that big head and shoulder breaks. But we're nowhere near that. We're all the way up here. So one thing at a time, guys. Now it could be this trading range. But if it does get there, okay, and then bounces hard, fails again, then the likelihood of a further breakdown back to the $300 level, which would be phenomenal buy, is very much there. So what I'm getting at, guys, is tactical trading is the only way you guys will survive this market. I can't take away your emotions. I have emotions. Okay, this is real money we're trading with. All right. And the bigger your trades are, the more fluctuations you'll see. It is no fun buying a bunch of S&P puts and seeing it being jostled around. You know, let's say you bought 4, you could be down $1,000 in 2 minutes. You can. Let's say you buy 4 at $6 because you bought in the money, or $5. Isn't it possible it goes to 3 in just because of a minor sell candle that comes through? Absolutely. However, in order to keep yourself sane, and not follow the same old-fashioned legacy trading techniques, you can't take more than a 30% loss. Yeah, good luck. Because who's taking a 30% loss if you can cost average down there and within the next hour the market turns around and goes ballistic? Case in point, today. So what did the retail traders do? They panicked their crap out of here. They never see these long tail hammer reversals that I saw, I played. And now they're sitting here saying, oh crap, I just lost a lot of money and I could have made so much more. That could have, should have, just so you guys know, eventually will burn your brain. That means you will never be able to come back as a successful trader. Listen, it's not how many times you fail on something, but if you keep on doing the same insanity over and over again and using your head, which means nothing in the scheme of things in this type of market, then what? You just never make it. I'm sorry. Tell all your friends to come by, visit us, learn the real deal. I teach things in a very simple way. The ones who want to take that extra step forward have been extremely successful. Read their member feedbacks that they write out of happiness and joy, not because I'm telling them to. Okay? How much has fundamentally changed their style of trading. Even through that, they take losses. But it's not the loss that you take. It's the 5 times more that you make more. We have shown that repeatedly. We have shown that in longer time frames. We have shown that in shorter time frames. We have shown that in a day. We have shown that in a day. Okay? Or we have shown that over a period of months, going back to, this is not even a month. It's amazing. So much volatility. Okay, bear with me 1 second. I'm trying to go back just to September. Okay, this is September. Okay, I finally got to September. Great. So here was September. So look, just between September and now, we have traded each one of these. Now, if you want to look at it, now that we have gone back to September, the big North Korean stuff and God knows what, bottom line is big impulse surge, trading range, big impulse surge, trading range. There's one more left. Okay? That's the way it goes. Trading range, breakout, trading range, breakout, and these are these trading ranges that screw the living, excuse my French, but sorry, it's basically, I don't have a better choice of words, screw the heck out of traders because they just don't know how to read these candles. They just don't know. So they're trying to use their head and they're repeatedly failing. This is, gentlemen, a bull market still. As long as the bull market is not broken below certain levels that I have talked about, explained in my video cast, that feel free to see the free ones, and the advanced coaching session students know exactly what I'm talking about, then you trade the upside more than you trade the downside. Majority are trading either the downside, not trading, or completely missing out. So on that note, Mr. Carmona, you're visiting us. Come join us, because it will fundamentally change the way you look at the stock markets. You keep on doing what you're doing, Jose, you're going to still keep on losing money like nobody's business. Trust me, I know these things. On a great evening, guys. Tomorrow's going to be a fun day, and get ready for volatility. Just look at my charts, try to understand them, and then you'll survive. Have a great evening, guys.